Hi, and welcome to Your Finance TV. We're kicking off February with this show, and we're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Hey, great to be here, Mehdi. Thanks for having me on the show.
January's done. We did hit some new all-time highs, but for me, it all felt a little bit blah with some low conviction moves. I say that, but we're in the thick of Q4 earnings, and there are certainly some doozies coming out, including some of the Mag 7 names. But enough from me. Jeff published his monthly review and outlook, which is available on Substack at hugeinsights.substack.com. And without further ado, I'd like to invite Jeff to kick off with his top down as usual.
Yeah, thanks, Mehdi. Obviously, the Mag 7 were the important companies reporting this week. We pretty much got the entirety of the full suite of the Mag 7 now. Apple was a bit of a disappointment last night. However, that was offset by both Meta and Amazon. Meta, I think, is up some 16%. Google had a tough run at it. Microsoft was somewhat disappointing. And obviously, we heard from Tesla last week, and that was a nightmare. The stock is down some 26% or so year to date. Those are basically the biggies. Nvidia had a nice quarter. I think, when it comes to what's driving the market, we've kind of widowed it down to, the Mag 5, if you will. Apple and Tesla are kind of sitting this one out. Everything else seems to be going great. I worry, I guess, about two things. Number one, the vast majority of these companies derive a good deal of their revenue from advertising. And so, I think advertising is an at-risk revenue stream if we go into a recession. The first thing a company cuts in a recession is their ad budget. And the reason they do that is because 50% of that ad budget is wasted. The problem is they don't know which 50%. So they just go through and wholesale cut it. I think that we're going to see some of that impact the click-through rates, et cetera. So I think you're going to have an impact on these big companies in terms of their top line growth over the next several quarters. Why do I say that? Well, because I think we are going to go into a recession in 2024. And it's possible that the NBER will even backdate the recession to a starting point in late 2023. A lot of the data that I am looking at, particularly on the credit side, is disturbing to say the least, and not indicative of growth. And we've said for some time that we've been in something of a rolling recession, right? We had 2 quarters of negative GDP growth back in 2022. Q1 and Q2 of 2022 were both down. And so, that was kind of a moment where a lot of people kind of raised their eyebrows like, was that a recession? It wasn't officially called a recession by the NBER, but it was indicative of recessionary conditions, things that you would expect to see during a recession. And so I think it's part and parcel to this rolling recession concept. Obviously the housing market has kind of been in the throes of recession with higher interest rates. We're hopeful always that, with rates coming down some, that's going to change. But there just isn't a lot of inventory. And so, the real estate market continues to suffer. I think the next big shoe to drop is going to be in commercial real estate. We're already seeing, a number of these things flow through into bank earnings. Most recently, New York Community Bank Corp, which had, kind of something of a disastrous quarter, writing down 185 million on 2 particular commercial real estate loans that they made. And, that ended up in a negative 193% earnings shortfall, or negative surprise, if you will. And the stock was down some 37%. I don't think that's a one-off. There's one guy who would probably agree with me, and that's Barry Sternlicht, billionaire commercial real estate investor. And Sternlicht's been out publicly discussing the fact that there is, a catastrophic event, if not an existential crisis in office commercial real estate right now. He thinks that there's something like 1.2 trillion in losses. We just don't know exactly where they are, but they're on some banks' balance sheets, probably many of the regionals, because that's really been the source of funding, across the board for the last couple of decades, and most recent decade, which is most important because, over the next 36 months, we're going to see something like, $2.8 trillion in CRE, mortgage debt come due and roll over and need refinancing. And that's going to require revalues. And we're seeing a lot of transactions, occur at, 10, 20 cents on the dollar. Most recently, we saw, a 16-story office building in Washington, D.C. just traded for $25 million vis-a-vis a $145 million transaction price in 2011. So this is somewhat catastrophic to that space. So where's this all going? Well, yeah, if we're going to go into a recession, then I think we're going to have some real problems in both the credit markets and the equity markets. And so with that, let's go through and talk about these things as you would like to.
Absolutely. Thanks for that rundown, Jeff. And that commercial real estate side is very interesting. A lot of people watching it. As you say, pennies on the dollar potentially, but that's even if you can get the financing redone. So, there's some keys being thrown in as well. So, we'll see how all this unravels. Jeff, I'd like to kind of have a look at inflation if possible. How's inflation looking? What are the implications for Fed rate cuts at this point? I know what Powell said last week, so that kind of put a little spanner in the works for a lot of people's thought process. So what are you thinking?
Yeah, we just heard from Jay Powell and company following the January 31st FOMC meeting, and Powell continues to believe that the economy is strong, employment conditions are robust, and inflation is subsiding, but we're not out of the woods yet, in his words. And, I think he said in answer to one journalist's question, will we see a cut in March? He said, that is unlikely, quote unquote. So I don't think that we're going to meet streets, very, very, rosy sort of expectations for rate cuts in the first half of the year. Even the consensus view, if you take a look at how betting markets are positioned right now, most are now shifted to kind of a May 1st, meeting date as the first cut. And that's only about 59% probability at this point. But the market's now pricing at about a total of 5 cuts before year end. Let's take a look. I mean, if we take a look at the Fed's dashboard on core inflation, okay, this looks at 9 different studies published by 6 different Federal Reserve banks. And, the Fed uses all of these models in aggregate to get a more complete sense of what retail pricing pressures look like. The street is very focused on this core PCE because historically dating back to Greenspan, that's kind of been the Fed's preferred metric. They can't really talk about the hodgepodge of 9 different models, in kind of a coherent manner in the period of time that they have to express their views in these 30-minute sort of pressers that follow up the FOMC meeting. So they're drilling down onto something that everyone can kind of hinge on. But the reality is, if you take a look at all of these measures in aggregate, we can see on the right-hand side in white, circled in red, that this is where all these models need to be if we're going to be at that core 2% PCE target. And we're well above those, on average about 180 basis points above where they need to be. In red, circled in white, we can see, where we are. And it's just we're not there yet. And so I think, Powell's comments should be taken at face value. I don't think he's trying to bluff or, jawbone the market. I think he's been very transparent. I think what he said this time is that, hey, you haven't been listening to me. You guys have been extrapolating what you want to hear, and just regurgitating that that message amongst yourselves, and it's got, you're playing a game of telephone. I said one thing, and by the time it gets to the 10th guy, who's come on TV to discuss it, it's been blown completely out of proportion. And so, let's leave it at that. Higher for longer than most on the street are expecting. What does that really mean? I think we probably start to see cuts in the back half of the year, and I think it's going to be in response to a degradation in growth conditions. And we're seeing a lot of this show up in some of our recession models.
Very interesting. Very interesting outlook as well. And let's have a look at liquidity, Jeff, if you don't mind. The M2 money stock has improved from what I can see.
Yeah, well, this is one of our recession models, right? We're looking at liquidity and M2, and yeah, it's improved from the depths of despair, but it's still contracting at quite a fast rate. Year over year growth is negative 5.4% December. This is the 22nd consecutive month where real M2 has contracted. That's a record. That's never happened before, and so I think that we need to be concerned. Now, the real issue is that, well, it's contracted from an extreme, right? And so, are we back to where we were, say, pre-COVID? Well, the answer is no. So there's still more contraction to go, I think. And I think that will continue to be an overhang on the economy and the capital markets and the banking system in particular as we move forward.
So, Jeff, you touched on this in your opening statements, but another hot topic has definitely been the impending credit crunch. And simple question: are we there yet?
Well, I think it's underway, no question. I would say bank credit is worrisome to say the least, and might be our biggest concern right now. And let me give you one stat, okay? Year over year growth of new commercial and industrial loans across all banks just turned negative for the first time since the GFC. Came in December at negative 1.3%. Now, let me also say that bank credit has never gone negative without preceding or within concomitant with a recession. So, I mean, this is a 100% certainty that when bank credit goes negative based on history, and this goes back to 1960, we've had a recession every single time. And so it's something to be concerned about. Typically, bank credit goes negative in the midst of a recession, but there's a couple of occasions where it's preceded the recession. And so, I think it's highly possible that we're already in recession. The data looks best at the peak, okay? And always, 100% of the time, the NBER predates that peak of data. They backdate the recession to where it starts. And it's usually, well, 100% of the time, it's before we see the peak data. Okay, so there's something happening under the hood that we're not seeing right now in the data. And but it's gradual. It's broad, right? It's happening across the board. It's been very gradual, and we just haven't seen the rug pull yet. And that's what people are waiting for. But by the time you see that, it's too late. You've got to be in front of it. The stock market peaks before the recession is acknowledged.
It's funny. It definitely feels like, people are looking over there at the stock market, but there's all this stuff happening over here that everyone's kind of missing on the recessionary front. But, we'll see how all this kind of rolls along. Jeff, unemployment, these levels, how are these levels looking? How do they play into this big picture narrative?
Well, again, back to my initial comments about the Fed cutting and when they'll cut. I think today's jobs number makes it very, very difficult for the Fed to, have any sort of cover, going into the May meeting, anyways, unless we see a complete reversal in the next couple of months. Job growth is just too strong. I mean, we just saw 353,000 new non-farm jobs added in January. That was way above street consensus. The consensus was 185,000, and there were a lot of, really well-regarded analysts on the street that were below that, thinking that we're going to miss. Okay, unemployment rate held stable at 7.3%. The street had been looking for it to tick up to 3.8%. That has affected the SOM rule. So the SOM rule is basically looking at the 3-month moving average of the unemployment rate off of its low, its 12-month trailing low, which got to around 3.4%. That 3-month moving average is now only 20 basis points above that. And so, it's ticked down from last month where we saw it was 23 basis points above that low. So still holding below the critical 50 basis point increase above that low. And so, now we've actually ticked down just slightly, 3 basis points, not the end of the world. I mean, one bad number can really change it. But the thing that I really think is interesting is that, everyone's been focusing on these downward revisions to the unemployment data. We've been getting good numbers, beating estimates month after month after month. And then, couple of weeks later, a couple of months later, we see the revisions posted, and they're like on, page C13 next to the obituaries. I mean, nobody even knows that it's happened, but suddenly they're revised lower by 100,000 jobs, and so it's kind of like a non-event. The market trades on the news, right? They don't trade on the reality, and so. What I think is most interesting about today's report is we saw upside revisions. So upside revisions to December by 111,000, and we saw just a modest upside revision to the November numbers, roughly 9,000. And so what we're seeing is that job growth has been really, really strong over the last 3 months, and that's going to make it difficult for the Fed to engage in any sort of an easing cycle. Whether they feel they have the ability to do so to normalize rate. Let's face it, 5.25%, 5.5% on the Fed funds rate was considered normal 20 years ago. Okay, it's only since the GFC that we got down into these ridiculously low numbers. That's been the anomaly. That's been the abnormal condition. The problem is the market re-rated around that abnormality. And so to get back to something that's normal is going to be very, very difficult for the U.S. economy in aggregate, right? There's going to be struggles, and it's going to show up next, I think, in commercial real estate and in the banks. But with respect to these job numbers and where we are with this indicator, they've been too strong to trigger the SOM rule indicator. And so that continues to be on neutral. It's the one model out of our 7 recession models that is not in, concerning territory.
So, Jeff, we had a better than expected GDP number last print. How's the economic indicator dashboard looking at this point?
So the dashboard, as you know, is really the LEI index. This is the leading economic indicators created by the Conference Board. Many of those indicators surround manufacturing, right? And I guess the one thing that I would say about the LEI is, it's been negative for 20 consecutive months. That's never happened before. In fact, the longest it's ever gone negative, I think, is 9 months with an average of 6 months, okay? So consecutively, we've seen 9 months, then a couple of ticks positive, and then it's gone negative again. We've had those sort of false dawns, right? But and if you aggregate it from the peak to the trough, we've seen 18-month periods before, so it's not completely unprecedented to go 18 months negative, but not consecutively. And now we're at month 20 in this, and so I think there's reason to question whether or not the model's either broken, okay, or coming recession is going to be an epic disaster, okay? And I'm more leaning toward the latter than the former, and here's why. This decline in the LEI, even though it's been manufacturing centric, okay, the things that have been positive have been credit spreads and the stock market, but also the services segments, okay? So there's been kind of a handoff from manufacturing to services. And as you know, the U.S. is a 70% consumer-driven economy. Manufacturing isn't what it once was, say back in the 70s and early 80s, to our economic system. So, maybe the LEI has too much emphasis on that, but, the same could have been said anytime in the last 25 years, and the LEI has functioned, perfectly within those periods as an economic indicator. So, I continue to believe it deserves the benefit of the doubt, and I think eventually it will roll over hard down again, even though we've seen an uptick from the lows. It's still negative, and it's still below negative 4.4%, which is the threshold for recession. And that's been the case for, I think, going on, maybe 16 months now. So, there it is. I mean, let's not ignore it. But at the same time, I think we need to consider what the message we're really getting from this indicator is. And I think it could have a much more significant meaning than a lot of people are attaching to it at this point.
So, Jeff, what does that mean? Let's have a look at some technicals. Talk us through the preferred Elliott wave count.
Yeah. Okay. So the market broke out to new all-time high a couple weeks ago, as we've been talking about in past videos. During our monthly, we just published our monthly review and outlook, and so we don't make changes to our opinions or ratings intermonth. We do it at the monthly review and outlook only. And so, the breakout above 4818 in the S&P 500 was significant enough, that we have two new record monthly closing highs, back to backs or sequential, which is what we require to make a change to our opinion. So that had us look at the S&P 500, where we've been neutral for the past year. We upgraded it to bullish. Okay. Now, what does that mean? It basically means that the trend is bullish. The trend is up. We've known that for a while, right? But the new highs confirm that trend. And so we have to acknowledge it in our rating. I mean, we're very disciplined technical approach. We have a very disciplined technical approach that we don't want to deviate from because of, our underlying concerns about other issues. So we look at every model standing on its own 2 feet. And we've had, our strategic risk allocation model has been bullish. It's been 80% long stocks. 80 is the most we go long stocks in that model. 20 is the least. So, we're 20% long or 20% long bonds and 80% long equities in that model. And, that model has largely been correct. So that model has been giving the correct message, even though we've been neutral with our technical opinion because we hadn't seen those new highs. Now we have to confirm it. So what are we really saying here? Okay, well, I guess what I'm saying is that the breakout above 4818 raises the odds considerably that the advance off the October 2022 low is a fifth wave. Okay, and so we've readjusted our preferred count to reflect that. And the preferred count shows that the entire advance off the March 2009 low looks like it's cycle wave 5. And if that's the case, we adjusted our labeling of the waves to reflect the October 22 low as primary wave 4. We had previously been looking at that as being intermediate wave 4. And so, I'm sorry, we adjusted that to be primary wave 4. And so the advance off of that level is primary wave 5. Okay, so that's where we're at. And if that's correct, and I think it is, okay, I think we've got definitive confirmation to that effect, then we've counted 5 waves up at intermediate degree of trend. Why do we think it's intermediate degree of trend? Well, because it's consistent with intermediate degree of trend everywhere else within the advance. And so, the percentage moves that we've seen have been in line with intermediate degree percentage moves. And so it stands to reason that we are now in intermediate wave 5 of primary wave 5. But if we dig a little bit deeper, we can see that we're actually finishing minor wave 5 of intermediate wave 5 of primary wave 5 of cycle wave 5 of super cycle wave 3. Now, does that mean that we've topped exactly, or is there more upside? Well, to be honest, I don't know. I don't know how much further the market can go, but I've got a couple ideas. Number one, we can say that if the market goes to S&P 4940, which would be a really good target for the S&P, because that would mean primary wave 5 is exactly 2.618 times primary wave 1, which was the initial foray off the March 2009 low. That is a really significant relationship. Fifth waves tend to have a strong Fibonacci relationship to first waves at the same degree of trend. And to get a multiplier or an extension of 2.618 times would be really, really typical. Okay. So that seems like a logical target. Also, we could take a look at the cup sort of base, that wave 4 low versus the wave 3, or I should say intermediate wave 4 low versus intermediate wave 4 high. That breakout now pushes, a potential target to 5,100. And then, of course, the breakout above the 4818 suggests that maybe something like 6,100 is a long shot. I'd put probabilities around it like this. I'd say there's a 60% probability that it's 4940. I'd say there's a 30% probability that the market stretches to 5,100 and change, maybe 5,150. And I'd say there's maybe a 10% probability that we get that, launch to 6,100. I think that's extremely low. And there's a lot of fundamental reasons that we don't have time to discuss right now. But from a pure technical perspective, I would say that the market is in the very, very late stages of a fifth of a fifth of a fifth of a fifth wave at cycle degree of trend. And once complete, that will end super cycle wave 3. Now, once super cycle wave 3 terminates, it will be followed by super cycle wave 4 down. That's a corrective waveform that needs to correct a super cycle degree advance that dates back to, roughly 1932. And so we had that 1932 low, a 90 plus year advance off of that. We're not going to correct that in 6 months with a 25% or 20% correction. Okay, it's going to be a 5 to 10 year ordeal where I think the market can correct somewhere in the neighborhood of, 2/3 to 75% of that decline, or that advance rather. So the decline is going to be, catastrophic to most people. I think it will be utterly merciless to bullish investors who, have bought into this AI theme and all these other, reasons driven by Fed liquidity that the market can go higher. Earnings just aren't there to support it. We haven't seen it as fourth quarter earnings have evolved. I think we're going to end up missing full year 2023 estimates by at least 1%, which means that they'll be flat year over year with 2021 or with 2022 rather. And, that suggests in my mind that the market is setting up for a big disappointment in earnings for 2024. And if we get into a recession, I think those earnings could come in somewhere like 15% down year over year. That'd get us to like 187. And at 187, stock market's currently trading like 26, 27 times those numbers. It's really unprecedented.
So Jeff, one of the things we've talked about on and off over the last several weeks and months is volatility. And it seems like it's been pretty non-existent in some of these market moves. But it does look, and I've said this again multiple times, but it does really look like it's poised for a snapback here. What are your thoughts on volatility?
Yeah, so we've been looking at the VIX and juxtaposing it to the skew index. The skew index really, the best way to describe it is this. I mean, when the skew's elevated as it is right now, we're like at 150%. Normal would be 100%, kind of that smile volatility. When we're elevated like this, it suggests that we've got, speculators buying out of the money calls at a very, very rampant rate. Okay, 50% more, demand for out of the money calls than out of the money puts. Is basically what the message from this. And why would someone do that? Well, they're speculating that prices are going to go higher, right? With options to do that. And these are out of the money options, and they tend to be longer dated. Okay, so now we look at the VIX. Okay, the VIX has been kind of bouncing off this 12.5% low, right? It's been there for some time, but since late December, we've seen a series of higher lows, right? We've moved up slightly, we've pulled back, moved up slightly, pulled back, moved up slightly, pulled back over the last month. Yep. And we've got this series of higher lows, and now we've recaptured the 21-day moving average, which typically occurs just as the VIX is ready to reassert itself to the upside, right? We've drawn a couple of trend lines here. I think if the VIX gets above 15%, we're going to have a really good shot at 18%. A breakout above 18% would then suggest a move to around 22%, and a push above 22% would then get us into the 34 to 38% range. But honestly, Mehdi, I don't think the VIX will peak in this next, cyclical move up until it gets well above 40%. We haven't printed above 40% in, say, 2.5 years. And I think that it will be above 40% before it peaks during this next sort of round of advances.
Understood. And let's have a look at margin debt here. To me, this is the scariest chart of the day. What are we looking at on this margin debt dashboard, and what does this imply to the broader picture of things?
Yeah, so I credit this study to another analyst who publishes this pretty regularly on Advisor Perspectives. I just really like the graphics that they've used. It's better than anything that I could put out, and so we've kind of hijacked it, and we've been showing it to our clients for a while. The reason I like it is because it doesn't just show where the market is relative to margin debt, which is, by the way, spiked up again through December. By the way, this is reported 30 days in arrears. So we just saw the December margin debt data in January. I think it was released like January 23rd or 25th or something. So you get kind of a late look at it, but it jumps some $40 billion back to like $701 billion. This isn't a new record by any stretch, but it's way higher than it was in 2007 and 2000 at the peaks of those last two big cycles, right? And so, 700 billion is nothing to snuff your nose at. But the more important thing is net credit balances. This is margin debt plus cash balances, right? Netting it all out. We're at nearly negative 400 billion. I think the exact number is negative 900 or 392 billion right now, right? What's negative 392 billion? What's the significance of that? It's not an all-time record high. It was negative 500 billion at the peak in November, December of 2021, but it's about 4 times higher than the average of the 2000 and 2007 net credit balance peaks. These were negative like 100 billion. And so, now we're at negative 400 billion. That tells me that investors are really all in here, right? And if we do get some bad news and the market bends to the downside more aggressively than the average trader can handle, well, we're going to get a pretty steep, series of margin calls. We could see those margin calls result in kind of an avalanche of selling. And I've said this in recent weeks that CTAs, vol funds, risk parity funds, these guys are net long U.S. index futures to the tune of $280 billion. This is around an all-time record high. And CTAs in general are trend followers, right? These guys don't have any conviction in what they own. They have conviction in the trend. When the trend bends, it's no longer your friend. And those guys change on a dime. They begin selling. Same with vol funds. When the VIX starts moving higher, these guys will reduce their exposure very, very quickly. And same with risk parity funds. I mean, they're just all about balancing risk. They don't have conviction in the underlying. They have conviction in low vol. And so, at the end of the day, we could see a spike in VIX, a collapse in out of the money option buying, and a downturn in the market due to margin calls that really just open the gate for an avalanche of selling from CTAs who are, record net long index futures, and this is going to put a lot of pressure on, the underlying markets. And so I could see, this being a catalyst for the next big decline in equity markets.
So, Jeff, this is obviously your monthly piece, and you break down multiple asset classes, macro assets, you take a look at global assets, and obviously US sectors, as you generally do. Before we wrap here, what is your favorite sector that you would like to, you feel most comfortable positioning yourself in?
Yeah, and let me just preface this by saying normally we publish ideas too, right? 5 longs and 5 shorts. We had a real tough time coming up with any new, really good long ideas, things that look like they haven't already gotten super extended. And so, we just, decided not to publish anything rather than publish bad ideas. And I could have put a few shorts on, but, I just like to balance things out. The other thing is, this week has been the week that precedes our newsletter, Huge Insights, the Big Picture. And so we've been kind of knee deep in the weeds here, trying to gather our thoughts and pull together the data and create the story that we want to tell around the markets right now. And honestly, on Monday, I had nothing. Okay. I didn't know where I was going with this thing. I really just didn't have any great ideas that I wanted to highlight. Here we are Friday morning, and I think I've got an epic newsletter. I think this might be one of the best letters that we've ever published. It's issue number 30, and I'm really excited about it. I can't wait to get all the finishing touches on it. I'll probably be up till midnight tonight editing it. It'll go out at 6 a.m. tomorrow morning. So anyone who is viewing this and wants to really get a sense of our deepest thinking, our distilled thought on the markets, go to hugeinsights.substack.com, sign up to get the newsletter sent to your email box and give it a look. So answering your question, what's my favorite sector? Well, last month we saw communications, right? Communication services was the leader, was up 4.4%. Real estate was the big loser, down 4.8%. Comm has definitely been a leadership. We've had it ranked highly in our work. It's been number 2 for some time. Tech has been number 1. Industrials moved up to number 3. Discretionary, tanked and got kicked way down on the list. But the one that's really been on our radar screen and continues to impress is healthcare. Healthcare was up 2.9%. It was the 3rd best performing sector last month, and we see a lot of potential in healthcare. There's growth and there's value in healthcare, but we think there's going to be a ton of M&A in healthcare because the big drug companies are really struggling to find growth. Outside of Merck, who has a fantastic new drug called Keytruda, it might be the miracle cancer treatment. Most of the other big drug companies are really suffering. Okay, Pfizer, they're having a problem with their vaccines. People aren't getting vaccinated at the same rate that they were back during COVID. And so that's put a lot of pressure on their top line. So they need to acquire growth. And the list goes on. I don't want to get into specific names here, but I think healthcare is the place where we're going to see a lot of action in M&A. I think we're seeing some pretty interesting earnings revisions to the upside, and we're starting to see that performance bleed through into relative strength. And I think that investors will start to get behind healthcare because it's still trading at a discount to the market, and it offers better than market, bottom up growth fundamental.
Jeff, as always, really appreciate your thoughts from Alpha Insights. And of course, and you mentioned it, but I do want to urge our viewers, make sure you check out Jeff's content on Substack at hugeinsights.substack.com. Thank you for watching, and until next time, good luck investing.